what we're looking to do is just give people a few little nuggets of wisdom and really open their eyes and unpack some of the things that's going on in the market at the moment. There's a bit of scaremongering, there's a lot of change, a lot that people need to understand, and I think our roles in having our individual relationships with clients, you as the accountant, us as the financial planner, and also for us to have a relationship.
I think that's really important.
Correct, really, really important. So let's try and get through a few of those things and why we think it's important.
Yep.
And if there's anything else that needs to be asked, we'll make sure that the contact details are available for you guys to shoot us across any questions that you might have out of the back of it.
Sounds good. Let's dive in.
Let's go. So I think this next question is probably really topical. You know that in Australia, investment properties and the old investment property is really topical and a huge thing for people. What's the most important thing for investment property owners to consider, and what's tax deductible for an investment property owner, and what things should they be looking at?
Yeah, that's a really great question. So it's making sure that you go through and keep track of all the deductions. That's generally the main way. I generally like to, particularly if you've got a couple of investment properties, keep a separate bank account. But it's going through and keeping track of things like interest, rates, insurances, getting your statement at the end of the year from your property manager. The other interesting one's depreciation. So the laws around that have changed continually. There's before a certain time where you had to own the property to claim depreciation on a second-hand property, but any new ones, you should really get a depreciation schedule done because it's a great deduction that you can add in.
Yeah, right. And so that, I suppose, to explain that to people, there's a difference between buying an existing dwelling and a new dwelling.
Yeah, absolutely. The tax consequences can be massive.
Yeah.
So now if you buy a second-hand property, as they're called, you're not entitled to claim any existing depreciation. So that's because basically before people were buying a property where it had already been depreciating and getting depreciated again.
Yeah.
Good one.
Yeah, really interesting.
Yeah, but now it basically has to be a new one, or you have to have done capital additions to it. So if you do buy a second-hand one and you add to it, then you can get a depreciation report done. Particularly good if you did like a granny flat or something like that.
Yeah, see, that's huge. There's so many nuances to it, right? It's not just a new property, it's capitalising an existing property and investing into an existing property. The same thing can be triggered. I think there'd probably be a heap of misconceptions out there that people don't really understand how that works.
Yeah, absolutely. And that's important. That's why it's important to get the right advice about it, because you might find on a cash basis it's actually positively geared, so the money that comes in and out, but on a tax basis it's negatively geared. So you can actually be getting some of that cash back in your tax return, which can really help you fund more in properties and build your portfolio.
So we're talking about the tax deductibility of investment properties, and it's all well and good for it to be available. What do you need as evidence? Like you can't just lob up to your accountant and go, oh, I've got an investment property, let's just get everything we can out of it. What do they need to be keeping for you?
There's a few different good ways to go about it. Generally, your property manager will offer to pay your council rates and some of your insurances as well. So if you've got that statement there, that's a really good place to start with, because it's going to encapsulate everything that's gone through there. The other really important thing is to keep your bank statements that have got your interest on your loans, but you can also get your end of year financial summary, which just makes your life a little bit easier. Instead of bringing in 20, 40 pages of statements, you can just bring in 2 or 3.
Yeah.
Is a good one. If you spend any capital expenditure throughout the year, that's also important to keep, because those things can't get written off straight away. They need to get depreciated over the effective life of the asset. So keeping those receipts, the dates, really important to get the most maximisation of your tax deductions.
So you'll have your work cut out for you this year with all those rate changes that we saw along the way. There's going to be a lot of chopping and changing. There's going to be a bit of work to be done, right?
Well, fortunately, if you go about it the right way and you keep your end of year financial statement, you can cut down the amount of time that we need to spend on it and save yourself a few dollars.
Perfect. So in a traditional sense, in financial planning, we don't really look at crypto because we can't. At the moment, it's not a financial product that we can deal with, but it's still pertinent, at least for your clients and a bunch of people that'll be listening.
Yeah.
How do you manage the CGT cost base for clients on their share portfolios and crypto portfolios and those sorts of things?
Yeah, it's important because they kind of intertwined, and a lot of people that have got shares now do have a bit of crypto, so you kind of want to know the best way to keep track of it. We do have certain types of software, and that's kind of where it makes your life easier. With your traditional share transactions, like off the ASX, you find that you're not really doing too many transactions. So there's kind of 2 options there. You can go through your buys and sells and work them out. Generally, like most people have got ComSec or things like that, where you can go through and print the past couple of years, and it's got a full summary of your buy and sell statements. But when you delve over into the crypto side, that's probably where the tax software becomes a lot more important, because you're going to find that your average crypto investor is going to do hundreds of trades. They're going to move coins around. So even when you move, say you move like Ether to BTC or something like that, that's actually a CGT event.
Yeah,
because
absolutely.
it's actually changing the nature of the investment.
And heaps of people aren't aware of that. There's a lot of people that are getting, I won't say getting stung, but there's a lot of people that aren't really conscious that, in a sense now, even though it is not a financial product that a financial planner can deal with, the ATO is absolutely monitoring what's going on in the BTC world. Even a lot of the coin wallets are now having to report to the ATO.
So any of your base exchanges have to report to the ATO to be operational in Australia. So your Coinbase, your CoinJar, your Binance, they actually all send to the ATO that you have an account with them. So when we bring up your pre-fill, it's going to show in there that you own crypto assets.
Yeah.
And if you aren't reporting any capital gains events and they notice there's money coming in and out, they're going to have a closer look.
And it's not a real good place to get stung by the ATO, is it?
Well, not really. And you've got to the gains can be pretty good. And this is where you've got to be really careful, because you might have a bit of say you move coins or something, and you moved say you moved from BTC to Ether or something like that, and it's gone up quite a lot, and then it's come back down. The way the CGT side of things work is you've triggered a high event, and that's your capital gain, but then you haven't moved the asset again on the downside, so you're just actually exposed to the gain. Yeah,
you're just carrying the gain through rather than realising the loss.
Well, you're going to pay tax on the gain instead of actually realising it back down and netting out your portfolio, because most of these aren't actually trade accounts. They're capital gains accounts. So you've got to be really careful on those on the capital gain side of things. Or get caught out. Yeah.
And look, and when we look at the relationship that we've got, the benefit of the way that you handle that CGT base of any of those things, even though that we can only really look at the traditional share type part, when it comes to dealing with a client, one of the biggest things that we find is that the speed of implementation and execution of some of these financial plans is critical. The market moves so much that having a relationship like we do, where we can seamlessly communicate what details you've got for the client that we need to make sure that we can transact, it just makes it so much easier. We get to capitalise on the opportunity that presents itself in the market, rather than waiting for a third-party accountant partner to be getting around to it when they have the opportunity, right? It just makes our relationship that much more harmonious, and ultimately, the benefit to the client is extraordinary.
Absolutely, couldn't agree more.
So, we're coming towards the end of financial year. You're staring down the barrel of a bit of work. What's the difference in turnaround for you guys between peak and off-peak season for tax returns? And I think another really interesting part that you could talk about to get people prepared is, what are some of the most commonly overlooked deductions and credits and things that they can get when they come and see their accountant?
Yeah, absolutely. No, that's a good question. I think off-peak, you're probably looking at 1 to 2 weeks, and then I'd allow on-peak season between, say, July and October, about 3 to 4. But I think the good thing about having a good relationship with all our stakeholders and financial planners is that we can get that information quicker. So if you got something on, and like I've got to get a loan or I've got to get something across the line, you can tell us that, and we can go, all right, we're going to prioritise it and get it out in a couple of days for you.
Yeah, we can work together to make sure it all just drops in this one.
That's a really good value proposition for the client, is that because we all work harmoniously together, is that we're going to be able to talk to each other,
of course,
and save that middleman time.
Yeah,
works out much better.
So what are the things that people are missing? What are some of the deductions and credits?
Yeah, it depends on what sort of field they're in, but generally it's going through making sure that you keep a logbook on your vehicle. That's a good one for any work-related travel that you've done. That can add up to be quite a lot.
And does that old is it a 6-week period that lasts for however long? There's a few common misconceptions around how deductions for cars work.
There's heaps of apps now which are really good, so they can go through, and anytime you get a new car, or over that 3-year period, you want to go through and redo your logbook. Or the other really great way is that, so that you're not having to do that 6 weeks, if throughout the year you've got to use your car a little bit, just keep a diary, because up to 5,000 kilometres, you can claim that as well. So depending on the type of car you got, it depends on how much you can claim.
Yeah, right. Really, really interesting.
Which is handy. The other side of things is making sure that you keep all your receipts for everything. So I think it's a little bit easier for the general taxpayer to go through and go, I'm not quite sure what I can claim. So if it relates to producing assessable income, so it could be like a tool, the tool of trade or something like that, or a subscription you need to do your job, then we can go through and assess it for you and go, yeah, look, this is or it isn't. And I think it's a little bit easier to go through it that way rather than you try and work out what you can and can't claim.
And it's not about, it's not about trying to game it. There is legitimately some deductions dependent upon what people do for work, what the specific tool of trade is. There's a whole spectrum of deductions that are available to people that they're probably just not aware of. So the thought probably just goes to the benefit of having a long-term relationship with an accountant or a financial planner. We educate people, right? It's all about, rather than having a transactional relationship, building a relationship so that you get educated to the extent that you understand all of the things that are available to you along the way, right?
Absolutely. We're like you guys in that regard, is that we like to actually educate the client so they can develop their knowledge of what they can and can't claim and what they can do in their business. So as they're going along, they develop the skills to know what they can and can't do, and that helps to take it to a higher level.
Perfect. So I've had a couple of instances, even with friends of mine. Owning your own business can be extremely lucrative, but also there's some pitfalls. What are some of the pitfalls and positives, I suppose, of starting a new business? And how can a relationship with an accountant like you help people not only start but grow their business?
Look, it's going to be one of the most exciting times and one of the scariest times of your life going through. There's lots of reward and lots of risk, and that's one of the important things when you're starting out a business. Develop a really good relationship with those key people, right? What we like to do is go through and give our clients really great contacts to establish themselves, go through and look at the key things where they're going to come undone. Generally, the first one is getting the right things in place, such as the structure, making sure that that's tax effective and minimising risk. Going through other key things like, generally I like them to go through and do a bit of a break-even analysis so they know what they're actually doing in their business, know where they actually stand.
Funny how many people don't actually know. They see money coming in and they assume profitability just because there's money in the bank. It's not necessarily the case, right?
No, and you got to keep in mind that you got statutory obligations to stay on. So you might have money in the bank, but you got to pay your GST bill, your tax bill, your super bill, and you've got to leave the money aside for those things. And as you get bigger, those complications grow. Then you start to get payroll tax and making sure you got money aside for workers' comp and all the other little things that can arise.
So all of those things that you've just listed are the common pitfalls that even I've seen. They're the big ones, right? Not putting money aside for BAS, not putting money aside for GST, not putting, super. People get caught up in super.
All the time. And look, the ATO, they're just not going to let it slide with the super bill.
No.
And they're actually starting to go through now and just order people that aren't doing it. So it's just one of those things where do it right and do it properly from the start, and you're going to help yourself get to where you need to be. Otherwise, you've got to make sure it's viable. That's the big thing. You want to make sure you're doing all these things right, otherwise you're not running a viable business and you're going to come unstuck. So analysing correctly at the start is going to set you up for success. And
your relationship with them then, I suppose, when I asked that question at the start, how does having a relationship, not just a transaction with an accountant, how does having a relationship with an accountant or an accountancy firm such as yourself help people? I think that aligns a lot to what we do as well. Our job is to educate and keep people in their seats, and in a lot of circumstances hold them accountable. So the accountability piece is where a lot of those common pitfalls that you've just listed out tend to fall down. People aren't accountable, they don't have oversight, and they don't have anybody, I won't say watching over their shoulder, but nobody tapping them on the shoulder going, hey bro, you got a big bill coming up, are we ready for that?
Look, that is a big part of it, and it's someone where I know you want to go out and talk to, you tell your friends one thing and other people have a different perception, but your accountant's someone that's going to know truly what's going on. And so it's important to have a good relationship with them where you can be candid and honest, tell them about the goods and bad bits of it, and they can go through and go, right, here's what you can do in that situation, here's a bit of an action plan on how to actually manage it and how to work through it. I think it's just that that oversight and a little bit of guidance gives you that security that you need.
So we've got a great relationship between our businesses, and we've seen the benefits of that in spades. What do you think, and how do we articulate to your clients and ours the benefit between their accountant and their financial planner having a relationship?
It really helps working with each other because we can, between us, we can identify which bits they actually need. So instead of going through, a big long list of things, between us we can identify the bits that together we think are really important for them, and that'll help them the most.
You know what? When we see a lot of industry data too, and one of the surveys that gets done really consistently comes out and says that one of the things that clients value the most is collaboration between their professional service providers.
Yeah.
We get to go to source, speak to each other, get exactly the right information to make sure that we're achieving, ideally, what the client wants to achieve within the right time frames with all of the right information available to the both of us. It just makes sense.
Makes a lot more sense, and it makes it really easy that we can talk to the clients in their jargon, but then between us we can talk in our jargon to each other.
Yeah.
We can just talk as professionals, cut straight through exactly what they need, and then we can make sure they deliver the products that are most essential to them. It's basically best value for them.
Yeah. I think that speaks volumes and it's really hard for people, I think, in both of our games. That first hurdle in any relationship is trust. And I think for us to have done a lot of that hard work up front for our clients, and to be able to refer with a level of trust around your competence and ability and how the client's going to resonate with us and whether we're a right fit in the first place.
Absolutely.
I think that probably does a lot for it too.
That's just so important for me. That's one of my biggest things for my clients is to really look out for them in all regards. Having a good relationship with you guys, I know what you like, I know you're competent, I know your knowledge, I know you've got all the right insurances, I know you've got all the right qualifications. So it's someone where we can work together, we can send them to you guys, and I know that they're going to get what they actually need and want, not that they're going to be sold some different product or it's going to go down some yellow brick road.
Yeah.
When I look at their stuff, I just really want them to get the components that I really think are important, but then also you guys can go over it, have a look and come back to me and go, hey, I think these are some things that you should consider, and then I can have a good chat about to the client why they should actually need them in place.
Awesome. Mate, thank you for your time today.
Absolute pleasure. Thank you.